Hey everybody, I hope you all are doing well and welcome back to Michael's Matters. And as I am, I am Michael. And now that we are in the new year, past the holidays and the New Year's and all that kind of festivities are over with, and if you had coverage in 2023 through a health exchange, so that could be Obamacare or healthcare.gov, or if you're here in California, Covered California, really whatever iteration of it is that you had, if you got health insurance through an exchange, you're gonna get a form 1095A that you will need to use to do your taxes in this April if you're a procrastinator, like me. So today what we're going to be doing is walking through how to fill out the 8962 form for 2023 with a fictitious 1095A and go step by step to give you some perspective on how to get this form filled out and why you may have to pay money back, or maybe why you're even getting money back if it went the other way, because really it's not 100% intuitive. Now before we get to it, if you like these videos, if you find them interesting, if you find them helpful, or if you at least find them useful, please don't forget to like and subscribe, because it really does help the channel to grow, and we are so thankful for that. Thank you. But also because you get updates when our newest and most informative videos get put out. Or now, let's get down to the video. So first things first, I want to start off this video with the fact that I am not a tax person. And although I may be a person who is taxed, I'm not a tax advisor, a tax doer, or any version of that whatsoever. So if you have any questions about your personal situation, reach out to a real tax person and they will be able to give you advice designed around your specific situation. This is just how I'm doing it, and maybe you can get some perspective on what is the best way for you to do it as well. But again, not a tax professional. Also, if you are concerned about the cost of getting someone who is a professional to help you with your taxes, there is free help out there in person wherever you are in the country through programs like VITA, V-I-T-A, which is a free program where volunteers go through a extensive training and can help you finish your taxes. And if you make less than $60,000 a year, it's also free. So I'll put a link to that, to the nationwide VITA tax locator, and you can check that out for yourself if you need it. Now, with that out of the way, let's talk about this form 8962, why it's there, and why you're getting it and who needs to fill it out. Now, the 8962 form is a form that the IRS uses to figure out if you got the right amount of help paying for your health insurance through an exchange during that year to quote unquote reconcile your advanced payment of premium tax credit, or as all of us cool guys know it as, APTC. The long and the short of this is that when you get health insurance through a health exchange, many people, in fact most people who do, get some sort of financial assistance to bring down the cost of their health plan to ensure that it's affordable. That assistance is actually a tax credit that is advanced. This means that in December of last year, when someone applied or updated or renewed their health insurance plan, they put an income on that application that they thought would be their income by the end of the year. That's December 31st of the following year. That income put on the application is what determines how much someone has to pay monthly for their health coverage, and that coupled with the household size, the location, and the age of the household and all the people in it is what's going to determine how much those costs are. Now, if any of those things change throughout the year and they didn't get updated on the health exchange account, then whatever those changes were, whether they increased or decreased how much APT someone should be getting or how much they should be paying monthly, it's going to get settled on this form, the 8962 form, based on the information that is finalized on your taxes. This also means that if you had a big jump in income and your income went up, then the exchange is helping you to pay for your health plan based on your lower estimated income. When you file your taxes, like you are probably doing right now, if the income is way higher because you got a raise, for example, or perhaps you sold a property, or maybe even you won the Wheel of Fortune, that 8962 will show how much is necessary plus or minus to adjust the APTC to fit with your income and household size. In practice, it means that if you made more money, you got too much APTC, you'll have to pay some or all of it back. Or if you made less money and we're not getting enough APTC throughout the year, then you could get more money back on your taxes. But ultimately, the number is based off what your income and household size is on your taxes, not what you estimated it to be in the previous year when you submitted or renewed your health insurance application. Also, as a side note, overall, the system does seem to cause a lot of problems, especially with folks who are doing their own taxes or who have adjustable incomes. But, there's not really anything anyone can do about it. So, or other than, I guess, write your congressperson, because it will literally take an act of Congress to get it changed. So all that being said, 8962 looks at your financial tax information compared to how much APTC you got. It says whether you have to pay some back or whether you get paid some back, or if you break even, if you got everything lines up perfectly. To take an example of this, here is a 2023 health plan with Molina for a 45-year-old person with a household of 1, and they live in California with an income of $45,000 a year. With that income, their Molina Silver plan has a total cost of $420.57, and that is primarily based off their age and their location. Now, that amount with that income is not affordable, so they are eligible for $166.53 of APTC per month, which brings their monthly plan cost down to $254 a month. And here in California, there's also a $1 subsidy that the state kicks in, so that's just added there. It'll be a little different if you're in a different state. Now, just to further this example, and it'll make sense when we fill out the 8962, if this same person had everything the same, except for they put $50,000 on their application as their income, then that same plan would still have the same overall cost, $420.57. But instead of $166 a month in APTC, they're going to qualify for $99 a month plus the $1 from the state. So all things being equal, save the income, that plan would be $320 instead of $254. Just keep that in mind as we go through the example. So if someone put $45,000 on their application but made $50,000 and chose the exact same plan, then the 8962 calculates whether or not that APTC is correct, and if not, how much of a difference needs to be adjusted for. Okay, so that is what the 8962 does in concept. Let's talk about how to fill it out. So on this form, you'll be using information from your 1095A form, which is sent to you usually in January by the health exchange, that shows that you had insurance for 2023 and for what months and how much money you got. Now, if you had work insurance, or if you had Medicaid or Medi-Cal or Medicare insurances, or even like VA, you're not going to get a 1095A. You'll get another version like a 1095B or perhaps a 1095C, but the 1095A is just for folks who got health coverage through an exchange and for what months they had it through those exchanges and they got subsidy for those plans. The 1095A form will include the names of who got health coverage, for which months they got coverage, and how much for each of those months. And again, these amounts, primarily the monthly APTC, is what is based off the income that you put on the healthcare application, and will be either too little, at which point you get money back, it'll be too high, at which point you have to pay money in, or just right where, it's a wash. Here's an example of that same fictitious person who enrolled in the Molina plan. We can see how much the total plan cost was in column A. Column B is the second lowest cost silver plan. And column C is how much the APTC for each of those months that they got. So with this 1095A, we can start to work on the 8962. So we will start with the 8962 with a fictitious name for a fictitious person who is not real, John Johnson, if you can't guess, as well as a fake social security number as well. And for A, it indicates that if you are filing married separately, that you cannot get PTC. But since John is filing single this year, that is not going to be a problem. So in part 1, line 1, it asks for the family size, and we will put 1 because it is just John. Then line 2A, it's going to ask for the adjusted gross income, which is what you would get from your 1040 form. In this case, we are going to say that John made $50,000 a year. But recall, on his healthcare app, he put $45,000. Line 2B is for dependents income, which is he doesn't have any dependents, so we can go to line 3, where it asks for a household income, which of course, all combined, still $50,000. Now, next we go to line 4, where it's going to ask information about the federal poverty level, or the FPL, which can change a bit depending on where somebody is in the United States. But in this case, since John is in California, we will use the chart 1-1 from the instructions for the contiguous United States and check the box C. and then put the amount for what is 100% of the federal poverty level. So that is the poverty line. So if you are below 100%, you are impoverished. And if you are above it, then you are not impoverished, at least according to the government, which for 2023 was $13,590. And you can see that on the chart. Next up in line number 5, we're going to figure out what was John's federal poverty level for him specifically in 2023 by going to the instructions again and then multiplying line 4 by 4.0, which gives us $54,360, which is 400% of the FPL. Not for nothing, but that is actually the limit. 400% is the maximum amount of income that someone can have and still get subsidy on their health exchange plan. So that's just a side note. Then it asks us if John's income is above or below that amount, the 400%. And at 50K, it is going to be below that amount. So then we divide the 50K by the $13,590. And that gives us 367% of the FPL. So that is what goes on to line 5. Line 6 is reserved for future uses, and I guess they leave us to ponder, what could that be there? Your guess is going to be as good as mine. Next, we get line number 7, which is the number we get from the instructions at 367, which is 0.0768, and that goes on line 7. So we look at the chart there on the instructions for 367, and that gives us 0.0768. Next is line 8A, and they're going to ask us to multiply line 3 by line 7. So that's 50,000 times 0.0768, and that gives us 3,840. 8B asks us to divide 3,840 by 12 to give us a monthly amount of $320, and that goes on line 8B. Now we're ready to move into part 2, starting with line 9, and since there are no other people on the account other than John, we can click no and move to line 10. In line 10, it is asking for the monthly amounts charged for him, but in this case, since we're saying that John's income was exactly the same, or he didn't make any changes, I should say, then the APTC did not change throughout the year, and we can just use the total annual amounts on line 11. Next up, we go to line 11A, which is the total cost of insurance for the year, which we can grab from that 1095A on line 33A, which is $5,046.84. For 11B, that number comes from column C on the 1095A, which is the same in this case because the second lowest cost silver plan where John is also the plan that he got. Then in 11C, it asks for what was the annual contribution amount, which was $3,840 from line 8A. 11D will ask us to subtract line C from line B. So that is $5,046.84 minus $3,840, which equals $1,206.84. Then for line 11E, it says it is the lesser of 11A or 11D, which is 11D, so we put that there. And then finally for 11F, it asks what is the total amount of tax credit that John got in 2023 from that 1095A line 33, which is $1,998.36. So with all those filled out, now we can skip to line 24 because we don't have to go month by month. And line 24 is asking us to put in the number from 11E. That is $1,206.84. And then in the next line, 25, what is the amount that John got during the year? So that is line 11F. So that is $1,998.36. And on line 26, it indicates that if line 25 is greater than line 24, then move on to line 27 because there's going to be some repayment. So next we go to line 27, which subtracts the difference between 25 and 24, and that comes out to a total of $791.52, which is how much extra APTC John got for 2023 because he made $50,000 and not $45,000 is what he put on his application. So lastly, for line 29, when we go back to the instructions, we can see that if the amount John has to pay back is more than the maximum amount that is allowable to have to pay back for someone who has an FPL of 367%, but his amount actually is less than the maximum, which is $1,500, So he is going to have to pay back 100% of that additional APTC that he was overpaid, the $791.52, which, by the way, if you divide by $12, you get a monthly amount of $65.96, which is just about the difference. If we go back to those millennial plans that we looked at in the beginning, it's the difference between the plan cost at $45,000 a year versus $50,000 worth of income a year. So just kind of circling all the way back and coming back to where we left off. So just kind of having come full circle, and we can see all the ends tied together neatly. So as we can see here, because John's income was $5,000 more annually at $50,000 rather than $45,000, he's going to have to pay some back. But ultimately, if you want to look at it this way, he isn't really paying any more or less than he should. He would have just had to have paid it throughout the year either way. So an additional $65 every month he didn't pay. So basically, if you want to look at it optimistically, he's getting an interest-free loan for $65 a month from the government. But where things start to get real hairy is for those folks who do have incomes that fluctuate wildly, like realtors and salespeople and boat salespeople, or really any salespeople. Where, they can make $45,000, or at least think they're going to make $45,000 and end up making, sell a house or sell a boat or sell a tractor or whatever they're selling and make $100,000. Good problems to have, but then they find out they got to pay back a lot of that APC, and that's usually where that comes in. So this also happens if a person is dropped from the household. So if people get divorced or a child moves out and is no longer on the taxes, it pushes somebody up the FPL level, and that's another reason that sometimes they have to pay back a lot of APTC. So those are just kind of situations that also arise as well. All right, so that's it for this year's walkthrough of the 8962, and I've had to try to make it a little bit clearer than we did in previous years about how it all works. And let me know if that helped, and if you liked the video, and if you actually found it interesting or helpful, or at least found it useful, please don't forget to like and subscribe, because it really does help the channel grow. And again, we are so thankful for that. Thank you. But also because you get updates when our newest and most informative videos become available. So again, for Michael's Matters, I'm Michael, hoping that you take care of yourself, take care of others, and have a happy, healthy